Welcome to The Explainer. Today, we're going to take the sometimes dense, intimidating math of personal finance and turn it into a gripping narrative about your financial survival. We're going to look right under the hood of wealth creation and, honestly, what's probably even more important, wealth protection. Basically, we are breaking down exactly how time interacts with your money.
Right out of the gate, I want to hook you with this terrifying paradox of wealth destruction. Picture this. Two people. They start with the exact same multi-million-dollar portfolio. Over a 25-year period, they both average the exact same percentage return on their investments. Yet, one ends up completely flat broke, and the other finishes as a multimillionaire. How on earth is that mathematically possible? Well, it's not a trick. It's a structural reality of finance.
Okay, here is our roadmap to figure out this multi-million-dollar paradox. 1. The power of compounding. 2. The retirement timing trap. 3. Two very different outcomes. 4. Protecting your nest egg. And 5. Understanding ordinary annuities. Let's dive in.
Section 1. The power of compounding. Before we can really understand how money is destroyed, we've got to establish the baseline of how wealth actually accumulates.
You've probably heard of these two concepts, simple interest and compound interest. Simple interest is, well, simple. It calculates interest only on the original principal you invested or borrowed, so it just grows in a straight, predictable line. Compound interest, though, that's where the absolute magic happens. It builds on both your principal and all the previously earned interest. It creates this incredible exponential snowball effect.
According to data from Saxo Bank, the real-world applications of these two are vastly different. Compounding is the engine that maximizes your long-term wealth. It is exactly what you want your investments doing. But you really have to watch out, because on the flip side, compounding can rapidly snowball into massive debt for borrowers, like with credit cards. Simple interest, on the other hand, is what you'll usually see with personal or car loans, where the growth is fixed.
Let's throw some real numbers at this to see that snowball in action. Say you invest $10,000 at a 5% annual interest rate for 3 years with annual compounding. You don't just earn a flat $1,500. You earn exactly $1,614.72. That extra $114, that is literally the interest you earned on your interest. But check this out. What happens when we simply change how often it compounds? If we take that exact same 10 grand at the exact same 5% rate for 3 years, but the interest is compounded monthly instead of annually, you get $1,618.62. Frequency absolutely matters. The more often interest is added to your principal, the faster your wealth takes off.
Section 2. The retirement timing trap. Okay, we've seen the magic of accumulation. Now we have to introduce the villain of our story. And this villain attacks during the decumulation phase.
Think about shifting gears from your working years into retirement. When you're still working and building wealth, a market crash is honestly just a temporary setback. It's actually a chance to buy investments on sale. But when you stop working and rely on those savings to survive, the math completely flips on its head.
Enter our villain, sequence of returns risk. Data from Mariner Wealth Advisors defines this as the threat of experiencing poor investment returns early in retirement. Basically, retiring into a falling market can permanently cripple your portfolio. Why? Because if you are actively pulling money out to live on while the market is crashing, you are selling off assets at the worst possible time. You're destroying your ability to compound in the future.
Section 3. Two very different outcomes. Let's look at a high-stakes scenario to make this math super tangible. This is going to solve that paradox I hit you with at the very beginning of the explainer.
Meet investor A and investor B. Both retire today. Both start with a $3 million portfolio. They both take an initial withdrawal of $150,000, and they adjust it upward by 2% every year for inflation. Now, here is the kicker. Over a 25-year period, both of their portfolios average exactly a 7% return. The only difference is the sequence. Investor A gets hit with 4 years of negative 10% returns right at the start, followed by positive years. Investor B gets the positive returns for the first 21 years, but suffers those negative 10% returns at the very end.
So here is the gut punch. Investor A completely runs out of money in year 19. Just let that sink in for a second. Even though they averaged a 7% return over their lifetime, Investor A is broke. And it's purely because those early losses forced them to sell a huge chunk of their portfolio just to get their living expenses. They cannibalized their principal, meaning there was literally no money left to capture the big positive returns that came later.
And this right here brilliantly illustrates the timing trap. Investor B finishes the 25 years with nearly $6.5 million. Remember, exact same average return. But because Investor B's losses happened at the end of retirement, their initial $3 million had decades to compound unhindered. This is exactly why you cannot just rely on average returns when planning your future. Timing is quite literally everything.
Section 4. Protecting your nest egg. You might think you're totally safe because an advisor projected a 7% average return. But as we just proved, to survive the timing trap, you need a strategic toolkit.
Look, we can't control the stock market, but we can control how our portfolio is built. We have to build structural defenses, like a financial fortress, so your wealth isn't liquidated at a massive loss during a sudden downturn.
One incredibly powerful defense is the three-bucket approach. This cleanly separates your money. Bucket 1 is for the short term, cash and low-risk assets to cover your immediate living expenses for the next few years. Bucket 2 is midterm, lower-risk investments. And bucket 3 is long-term, your heavy-hitting growth engines. So if the market crashes the week you retire, you don't panic. You just live out of bucket 1. This gives your long-term growth assets the time they need to bounce back without you being forced to sell them at a loss.
A couple other vital tactics include stress testing your portfolio, simulating how different market crashes would actually hit you, and utilizing buffer assets. Buffer assets are things like the cash value of a permanent life insurance policy or a real estate line of credit. Because these don't plummet when the stock market crashes, you can tap into them for cash instead, giving your primary investments time to recover.
Section 5. Understanding ordinary annuities. Now, what if you just want to outsource this entire headache? Another really powerful tool for turning lump sums into reliable survival funds is the annuity.
Simply put, an ordinary annuity is a series of equal payments made at the end of each interval. It's kind of like the reverse of a savings account. Instead of putting tiny amounts in over time to get a big lump sum later, you take a lump sum you already have and structure it to pay you a steady sequence of smaller payments over time. It's basically a DIY pension. Now, this future value formula looks like alphabet soup, I know, but it really just boils down to two huge variables: the interest rate and the number of periods. Like we saw earlier, the higher the rate and the longer the time, the larger your series of payments snowballs into a massive future value. You just let the math do the heavy lifting.
On the flip side, we have the present value calculation. Think of this as a financial time machine. It tells you exactly how much cash you need today to guarantee a specific income stream for the rest of your retirement. It is the mathematical bedrock of turning your savings into predictable, stress-free cash flow.
So we've seen how compounding can build incredible wealth, but also how a poorly timed crash can completely wipe out a perfectly average portfolio. As we wrap up this explainer, I have a challenge for you. Look at your own portfolio. Are you just blindly chasing average returns? Or are you actively structuring your assets to protect your wealth from the sequence of returns villain? Because the math of time and money is happening to your portfolio right now. The only question is it working for you or against you?